Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel @Accounting Buddy NB. In this lesson, we advance from basics to practical complexities of depreciation. Learn how to handle change in method from SLM to WDV and make retrospective adjustments with correct journal entries. Understand depreciation on sale, addition or disposal of assets and its impact on profit and loss and balance sheet. Master the WDV method with step-by-step illustrations and comparison with SLM. Lesson also includes practical ledger, multi-year examples, and real-life scenarios for complete clarity. So sit back, relax, and watch the full video till the end and master the topic of depreciation. In this illustration, the cost of a fixed asset purchased on 1st of January 23 is $150,000. Depreciation charge for each year is $15,000. The business follows calendar year as accounting year. How the fixed asset will be shown in the balance sheet as at 31st December 23 and 31st December 24 under the two methods. Let us first learn how the asset account appears in the balance sheet when depreciation is credited to the asset account. Abstract of the balance sheet as on 31st December 23 is appearing on your screens. Fixed assets are always shown on the asset side of the balance sheet. Value of the fixed asset as on 31st December 23 is $150,000 and the depreciation for the year amounting to $15,000 when deducted from the asset value, written down value or the net value of the assets $135,000 as on 31st December 23 will be shown as displayed on your screens. The abstract of the balance sheet for the next accounting year as on 31st December 24 is displayed on your screens. The closing balance value of $135,000 as on 31st December 23 will appear as the opening balance of fixed asset for the accounting year 2024. From this value of $135,000, depreciation amount of $15,000 for the accounting year 2024 is deducted and the new written down value or the net value of the fixed assets of $120,000 as on 31st December 24 will be shown as displayed on your screens. In this slide, let us learn how the fixed asset will appear in the balance sheet when the provision for depreciation account is maintained. Abstract of the balance sheet as on 31st December 23 is displayed on your screens. Original purchase value of the fixed asset as on 31st December 23 is $150,000. From this original purchase value of fixed asset, the balance lying in the credit side of the provision for depreciation account amounting to $15,000 is deducted and the net book value as on 31st December 23 for $135,000 will appear in the balance sheet. Now abstract of the balance sheet as on 31st December 24 is appearing on your screens. The purchase price or the original cost of the fixed asset for $150,000 will be written as shown on your screens. Now the value of the accumulated depreciation as on 31st December 24 is $30,000. That is $15,000 for the financial year 23 and again $15,000 for the financial year 24. Therefore, this accumulated depreciation amounting to $30,000 will be deducted from the original fixed asset cost of $150,000 and the net asset value of $120,000 as on 31st December 24 will be shown in the balance sheet. The provision for depreciation account or accumulated depreciation account shows the total depreciation provided on the fixed asset from the date of purchase till date. Let us understand how the depreciation on addition to the fixed asset is charged and how the depreciation on the fixed asset sold is handled. An addition to the existing class of assets or an extension to an existing asset which is of capital nature and which becomes a part of the existing asset, it is also depreciated over its estimated useful life. On the value of addition to the fixed asset during the accounting year is charged from the date on which the asset is purchased till the last day of the accounting period. If an asset is sold, depreciation is charged on the asset sold from the beginning of the accounting period in which the asset is sold till the date on which the asset is sold. In this slide, let us learn the difference between the depreciation account and provision for depreciation account. Depreciation account is a nominal account while the provision for depreciation account is a representative personal account. Depreciation account always has a debit balance while the provision for depreciation account always has a credit balance. Depreciation is a temporary account as it is transferred to the profit and loss account at the end of every accounting period, while the provision for depreciation account is a permanent account and is carried forward to the next accounting years and appear in the balance sheet. Depreciation account is opened when an asset is shown at its written down value, while the provision for depreciation account is opened when an asset is shown at its original value. Depreciation account appears in the profit and loss account but not in the balance sheet, while the provision for depreciation account appears in the balance sheet and not in the profit and loss account. In this slide, we will learn the methods available for charging depreciation. The amount of depreciation for every year is calculated by using different methods. But the two most commonly used methods for calculating depreciation are straight line method and written down value method. First, let us understand straight line method, which is also known as the SLM in short form. Amount of depreciation each year remains same under straight line method unless there is an addition to or deletion from the asset. Under this method, depreciation is charged at the given rate of depreciation on the original cost of the asset every year. Therefore, the depreciation charged annually remains the same. For example, the cost of a fixed asset is $80,000 and the depreciation is to be charged at the rate of 10% per year. In this case, $8,000 depreciation will be charged every year. The assumption in this case is that the estimated useful life of the fixed asset is 10 years and it will not have any scrap value. When depreciation is charged under the straight line method and the asset has a residual or scrap value at the end of its estimated useful life, the amount of depreciation is determined as follows. Annual depreciation under straight line method is equal to cost of asset minus scrap or residual value at the end of the estimated life divided by the estimated useful life of the asset. Rate of depreciation under the straight line method is calculated or is equal to the annual depreciation divided by total cost of the asset and multiplied by 100, and that will give the percentage rate of depreciation. Under straight line method, depreciation may be expressed as a percentage of the original cost. If the estimated useful life of a fixed asset is say 10 years, we may say that the depreciation is 10% of the cost every year and the asset does not have a scrap value. Therefore, if the cost of the asset is $75,000, the depreciation will be $7,500 per annum. In the first year, the asset may be used for a part of the year. In that case, proportionate amount will be provided as depreciation. Now, in the above case, if the asset is purchased on 1st of April 24 and the accounting year closes at 31st December 24, depreciation will be provided for 9 months for the year 2024 and will not be provided for the full year. Therefore, the depreciation for the year 2024 will be $5,625, that is full year depreciation of 7,500 divided by 12 multiplied by 9. In this slide, we will learn advantages of the straight line method of charging depreciation. It is a simple method of calculating depreciation as the amount of depreciation each year is same. In this method, assets can be depreciated up to the estimated scrap value or the zero value. In this method, it is easy to know the amount of depreciation. Let us now talk about the limitations of the straight line method of providing depreciation. This method assumes that the amount of depreciation is same for all the years. This is unrealistic assumption as the usefulness of an asset to the business is maximum in the initial years as compared to the later years. With passage of time, work efficiency of the assets decreases and the repair expenses increases. In comparison to earlier years, higher repair expenses are debited to the profit and loss account than the later years. Sometimes in this method, the book value of the assets becomes zero. Still, the asset remains in use in the business. Another illustration on your screen is Tully Trading LLC imported a machinery for $230,000 on 1st of January 24 and spent $40,000 on custom duty and freight, and also paid $10,000 for its installation. Its estimated useful life is 10 years and the realizable value at the end of the estimated useful life is $21,000. Accounts closes on 31st December 24. Determine the amount of annual depreciation and the rate of depreciation. Let us first find out the total cost of the machinery imported. In this illustration, the cost of the asset, that is the machinery, is equal to the sum total of the purchase price plus the custom duty and the freight paid plus the installation charges paid for the machinery. Purchase price of the machinery is $230,000. Custom duty and the freight is $40,000 and the installation charges are $10,000. And the sum total of all these comes to $280,000. Therefore, the total cost of the machinery is $280,000. Let us now calculate the annual depreciation amount. Annual depreciation amount is calculated when from the cost of the asset we deduct the scrap or the realizable value of the asset at the end of the estimated useful life of the asset and then divide it with the estimated useful life of the asset. In our illustration, the total cost of the asset is $280,000. Scrap value is $21,000. Therefore, the estimated net cost of the asset at the end of its estimated useful life is $259,000. When we divide the amount of $259,000 with the estimated life of the asset, which is 10 years in this case, we will get the amount of annual depreciation of $25,900. Now let us calculate the rate of depreciation. Rate of depreciation is equal to the amount of annual depreciation divided by the total cost of the asset and multiplying by 100, and the result will be equal to the percentage of the depreciation rate. In our illustration, the annual amount of depreciation is $25,900, and when it is divided by the cost of the asset of $280,000, we will get 9.25% as the rate of depreciation. That means if we apply the percentage of 9.25% on the asset value of $280,000, we will get the annual depreciation amount of $25,900. Let us take another illustration. Tully Trading LLC purchased a machinery on 1st of July 2022 at a cost of $135,000 and spent $15,000 on its installation. The firm charges depreciation at the rate of 10% per annum every year. The accounts are closed on 31st December every year. Show the machinery account and depreciation account for the financial year 2022, 2023 and 2024. Header of a machinery account is appearing on your screens. The transactions for the financial year 2022 are now displayed. On 1st of July 2022, machinery for $135,000 is purchased, and on the same day an amount of $15,000 is paid for its installation. Both these amounts will be posted on the debit side of the machinery account, by writing the words to bank account in the particulars column. On 31st December 2022, depreciation amounting to $7,500 for the financial year 2022 is charged for a period of 6 months, that is from the date of purchase of machinery till the end of the financial year. Annual depreciation at the rate of 10% per annum comes to $15,000 for the full year, and proportionate amount of depreciation for 6 months comes to $7,500, which is posted on the credit side of the machinery account by writing the words by depreciation account. Depreciation amount is credited to the machinery account because it reduces the value of the asset. Now, if from the left hand debit side total of $150,000, right hand credit side transactions are deducted, we are left with a balance of $142,500 on the right hand credit side of the machinery account as on 31st December 2022, and it is recorded by writing the words by balance carried down. The account is balanced as the left hand debit side and the right hand credit side are now equal. Now the machinery account for the financial year 2023 is displayed on your screens. The closing balance of $142,500 of the machinery account as on 31st December 2022 will become the opening balance as on 1st January 2023 and is written on the left hand debit side of the machinery account by writing the words to balance brought down. On the last day, that is 31st December of financial year 2023, depreciation entry for $15,000 is posted on the right hand credit side of the machinery account by writing the words by depreciation account. From the left hand debit side total of $142,500, when the transactions of $15,000 on the right hand credit side is deducted, a closing balance in the machinery account amounting to $127,500 is left as on 31st December 2023 and is shown on the right hand credit side of the machinery account by writing the words by balance carried down. The machinery account as on 31st December 2023 is said to be balanced. Now the machinery account for the financial year 2024 is displayed on your screens. The machinery account closing balance of $127,500 as on 31st December 23 becomes the opening balance as on 1st January 2024 and is written on the left hand debit side of the machinery account by writing the words to balance brought down. The depreciation for the financial year 2024 amounting to $15,000 is recorded on the right hand credit side of the machinery account as on 31st December 2024 by writing the words by depreciation account. Now from the left hand debit side total of $127,500, when the transaction of $15,000 on the right hand credit side is deducted, a closing balance in the machinery account amounting to $112,500 is left as on 31st December 2024 and is shown on the right hand credit side of the machinery account by writing the words by balance carried down. Thus the machinery account as on 31st December 24 is said to be balanced. Now the closing balance in the asset account for $112,500 as on 31st December 24 will become the opening balance as on 1st January 2025 and will be written on the left hand debit side of the machinery account by writing the words to balance brought down. Depreciation account for the financial year 2022 is displayed on your screens. For the first year, that is financial year 2022, depreciation will be charged for 6 months, that is from the date of purchase of machinery till the end of the financial year. In this illustration, the machinery is bought on 1st of July 2022 and till the end of the financial year, that is 31st December 2022, machinery is used for 6 months. Therefore, proportionate amount of $7,500 as the depreciation amount will be charged for the financial year 2022. Entry is posted on 31st December 2022 on the debit side of the depreciation account for $7,500 by writing the words to machinery account. Since the depreciation being the cost of the business is a nominal account. Therefore, at the end of the financial year, that is on 31st December 2022, the depreciation amount of $7,500 is transferred to the profit and loss account by writing the words by profit and loss account. Now for the financial years 2023 and 2024, the annual depreciation on the last day, that is 31st December 2023 and 31st December 2024, amounting to 15,000 for each year, will be recorded in the nominal account of depreciation by writing the words to machinery account. The depreciation of 15,000 for each year will be transferred to the profit and loss account of the respective financial years. Let us take up another illustration. Jolly Trading LLC purchased a machinery for $482,000 on 1st of January 2024 and spent $18,000 on its installation. Its estimated useful life is 10 years and its realizable scrap value at the end of its estimated life is $50,000. Accounts are closed on 31st December every year. Determine the amount of annual depreciation and the rate of depreciation under straight line method. We have learned that the cost of the asset is equal to the sum total of its purchase price plus installation charges. Purchase price in this illustration is $482,000 and installation charges are $18,000. Therefore, the total cost of the machinery in this case is $500,000. Now let us find out the annual depreciation for this machinery. The total cost of the machinery is $500,000, and when we deduct the realizable scrap value of $50,000 at the end of its estimated life, we get the net value of $450,000 for the machinery. When we divide $450,000 by the estimated useful life of the machinery, which in this illustration is 10 years, we will get the annual depreciation value amounting to $45,000. Now let us calculate the rate of depreciation. Rate of depreciation will be calculated by dividing the annual depreciation amount of $45,000 by the total cost of the machinery, that is $500,000. In our illustration, the rate of depreciation is equal to 9%. In my next lesson on 10th of January 2026, we continue our journey through depreciation accounting by recording depreciation for the second and the third financial year without maintaining a provision for depreciation account. You will learn how to pass journal entries year after year using the direct method where depreciation is adjusted straight to the fixed asset account. By the end of this lesson, you will clearly understand the full 3-year impact of depreciation when no provision account is maintained. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share and like my YouTube channel @Accounting Buddy NB. Thank you and goodbye for now.